Worried that extra December paycheck will push you into a higher tax bracket? In this episode, we break down how taxes are actually calculated, clarifying marginal versus effective tax rates, and year-end strategies that let you welcome every extra dollar.
Your creative genius deserves the same precision behind the numbers.
Welcome to Let's Get Fiscal, hosted by Anastasia, Myiesha, and Danielle.
Part of the women-led team at Coterie Tax.
From smart tax moves to cash flow strategy,
we decode everything it takes to run a thriving creative business
so you can scale with confidence and sleep easy at night.
Press play and let's grow your business.
Hi, welcome to the Let's Get Fiscal podcast. I'm Myiesha and my co-host Anastasia is here. And today we are going to be talking about taxes and tax brackets and all that other fun stuff.
Right.
Yeah.
How taxes are actually calculated.
Yeah. How are they calculated?
I mean, because I noticed on one of the episodes, I said something about like, oh, if their tax rate is 11%. And I was like, I didn't really explain that because there's not an 11% tax bracket. So I was like, that's going to create some questions.
So let's just dive in.
Right.
How are taxes calculated?
Right. So we use a marginal tax rate.
Okay.
So, and it's a progressive tax rate. And what ends up happening is we have buckets of different dollar thresholds, and each one is going to be charged a different rate.
Okay.
And as you earn more, the money is going to be taxed more.
Okay.
So, for example, you have your standard deduction. 2025, that's going to be $15,000. So the first $15,000 that a single person earns is not going to be taxed at all. That's going to be 0%.
Okay.
Then the next $10,000 or so, it's like a little bit under 12, is going to be charged at 10%.
Okay.
And then from there, it's going to progressively move up. And every single year, it's indexed for inflation. But it doesn't matter if you earn $30,000 or $300,000, you still have that same progression.
Okay. So is it like, it's not accumulated though, right? It's not like that first 10,000 is 10% and then the next 10,000 is at 20%. So then it's 30% or no. Okay.
No,
no,
it doesn't turn. And that's where a lot of people get confused because, they're like, okay, well, I'm in the 35% tax bracket.
Yeah.
So that means that everything that I earn is charged at 35%. And that is not true.
Okay. So is it like steps?
Only, yes.
Okay.
Yes.
Okay.
So if you look at the steps, that's going to be the specific tax rate for each of those steps. So I'll look at the IRS tax website.
Okay.
So again, we're just going to use single.
Let's do it.
Filing jointly generally is going to be double the amount. So like I said, the first $15,000, not going to be taxed at all.
Makes sense so far.
Then we have income like under $11,000 after we already subtract the 15.
Okay.
So that's where it can get a little bit tricky because now we're really talking about like 26,000 and they subtract the standard deduction and that leaves you with $11,000 left. That's going to be charged at 10%.
Okay. I'm still with you.
Then when your taxable income is between $11,925 and $48,475.
Okay.
So in between those two numbers, you're going to be charged 12%.
Okay.
Then once you make $48,476 up to $103,350, that's going to be charged 24%.
Okay. So they're really separating out your overall yearly income into these smaller brackets. And as you hit them, like that's getting deducted, I guess, basically from it and they're taxing it and then it's going forward. Okay. Okay. Well, that makes a little bit more sense than adding up all those percentages and being like, that's a high amount of tax. Yeah. Okay.
So right. You have, once you take away that standard deduction, anything under 11,000 going to be charged 10%. Then between the 11 and 48,000, it's 12. 48 to 103 is 22. Then 103 to 197 is 24. but it's really only that $1 over that threshold is getting charged that. So for the example of, let's say you made
doing easy math.
Yeah. But like an easy one is the $48,475.
Okay.
So if you make $48,476, that extra dollar is going to be charged 24%.
Gotcha.
But not the money below it.
Okay. That's going to
stay at that 22,000. So when people say like, oh, that's going to push me into a new income tax bracket, it's not all the money that you earned before is suddenly going to be recalculated at this higher rate. It's just whatever dollar amount you get
above that threshold
is now going to be charged at a new income tax bracket.
I am 33 years old and I had no idea how any of that worked. That makes a lot of sense. I've been working a very long time. Yeah.
It's not always the case.
Okay. So what are the other ones?
In other countries, they actually will if you make above a certain amount, they actually retroactively go back and they'll remove your standard deduction because they're like, you don't need it. You make enough money. So we're going to go backwards and charge you more. The United States is not like that. Okay. So like I said, if you were single and you made $300,000, you're still going to get that same $15,000 standard deduction, and you're still going to have exactly the same progression as somebody that made $30,000. It's just your progression is going to continue, and theirs is going to stop at that time. And then also you want to think the brackets are fairly wide.
Yeah.
So that's where, you could be in the 24% tax bracket and be making $50,000, or you could be in the 24% tax bracket and making $100,000.
Yeah.
And you're in the same tax bracket.
Yeah. Yeah.
So then you're like, okay, but that, if I'm making $100,000, I'm going to be paying significantly more in taxes than somebody that's making $50,000. So how do I normalize that if we're both technically in the same exact tax bracket? And that's where the effective tax rate comes into play.
Okay, so everything before was marginal, right?
Yeah,
okay. Yeah. So now what is the effective one?
So the effective tax rate is your tax divided by your taxable income. So it's every single dollar, once you've applied those marginal tax rates and, each individual dollar has been charged its appropriate rate, you get to your total amount of tax. And then you're able to see, if I take $1 on average, how much of this $1 is actually going to be taxed. So in the same example, somebody who's making $50,000, they would have close to like a 15% effective rate. But somebody that's making $100,000 would have a 21% effective rate.
Gotcha.
So when we're looking at tax strategies, we're really identifying what is the effective rate that you're at right now, and can we do anything to decrease that effective rate? So that's why I say when I say 11%, I'm talking about their effective rate. So if they have $100, they earn $100, $11 is going to go to taxes. I wouldn't say, they're in the 24% tax bracket, so out of $100, they're paying 24.
Yeah.
I'm really looking at, the total situation, and as you earn more, how much does that affect each individual dollar?
That makes sense. I had no idea, but it does actually make a lot of sense. Yeah.
That's a lot of people are thinking that it's an effective tax rate, and that's how the IRS is charging you. And that's not how, taxes are calculated. They're calculated under that marginal rate. So when people say like, oh, should I take that extra money, even if it like pushes me into this next tax bracket, the overall effect, unless it's like a huge windfall amount, most likely it's not going to have a significant effect on your effective tax rate. So just take it.
Take the money.
Take the money.
Okay, cool.
So, and my position is always take the money because you don't know the situation of the other person. I mean, we've seen companies go bankrupt overnight. So somebody offers you money, then you should take it. But you also have this concept of constructive receipt that comes into play.
Okay, so what is that?
So constructive receipt is, for most taxpayers, they're going to be cash basis, which means as you receive the money, you have to pay taxes on it. So versus accrual basis where you pay tax as you earn it, you know, but you could have somebody that, you know, you invoice them and they pay you 90 days later.
Yeah.
You know, so that's where the IRS is saying, especially for small business owners, it's going to be cash basis. So when you receive the cash, that's when we're going to charge you tax on it. But when you receive the tax doesn't mean when it's actually deposited into your bank account.
Okay.
So when you receive the cash is when the person says this money is available to you.
Gotcha.
So if they call you up and they say, hey, I have a check right here on my desk, that's taxable income right at that moment. It doesn't matter if you're out in the Bahamas for the next 2 weeks and then you come back after the holidays and you deposit it on the 5th of January, because that person said this money is available to you right now, you have to claim it. So if you, I mean, I have people say, well, maybe if I just don't deposit the check. If it's in your hand, it's your money. It doesn't matter that you decided not to deposit it because the IRS doesn't care. You could do whatever you want with your money, but they said that this money was available to you. So that's where we have the constructive receipt part, because it doesn't necessarily mean that you have received it. It's you've constructively received it, which means it's as good as you've received it because you could just ask at any moment. So that's another thing where if you say, well, you know, I'll just wait until next year, you may not have that choice. So just deposit it into your bank account. Just deposit that check. And I always say too, I'm not too worried about some of these larger payments. I mean, obviously, if you decide to sell your company and you sell it for $300,000 and it's the last day of the year, that might be a conversation.
That we should have.
But if it's, you know, $10,000, $20,000, $30,000, it's not going to have enough of an impact because there's other things that we can do after the end of the year that will help bring down your effective tax rate. And then, like I said, I'm not really looking at what tax bracket you're in. You're you know, in that progressive tax scale, I'm looking at what is your effective rate, because if you're getting charged $11 for every 100 that you earn, then I want to keep that going. You know, so the number itself may increase, but the percentage of taxes to earnings, I want to keep it fairly steady.
Okay. No, that makes sense.
So some of the things that are available after the end of the year are going to be funding your retirement. That's always a really easy, low-hanging fruit. So if you have your SEP IRA or even a traditional IRA, being able to take these extra funds that you weren't able to use. And that's why I say, like, don't go out and buy a brand new computer for $3,000. Let's just put it into your traditional IRA. And with those, you have until April of the following year. So we have the time to be able to decide, does that make sense for you? Does that bring down your effective tax rate enough where you think that you would consider this, you know, as a good use of funds? And one of the things that I also try to be really careful of is because, again, they have a windfall amount of money. They get it before the end of the year. So the idea is, let me spend it on some business equipment or gear or a car right before the end of the year.
Because I feel like we've talked about that. Well, you shouldn't do that, right?
Well, I mean, you can, but it may not have as large of a benefit as you're thinking.
Okay.
The IRS kind of, you know, they catch on. They know, they know the strategies. So if you purchase like 40% of your equipment in that last quarter of the year, instead of letting you take half a year depreciation in that first year, they actually backtrack everything to the quarter that you purchased it in. So, for example, under the depreciation method called makers, I don't know if you're kind of nerdy and you want to know all of that, in that first year, you get half a year of depreciation. So it doesn't matter if you purchased the item in September, which is less than half a year that you've had it, they'll give you that half a year deduction. But like I said, if you make all of your purchases in that last quarter, they're going to say, hey, no, we know what you're doing. You're just buying up a whole bunch of equipment to lower your taxable income. So they're going to do it by the quarter.
Oh,
so
okay.
That's where, if you would purchase things in January and June and everything, then even though you purchased it in December, you would still get half a year going all the way back to June where you could claim the depreciation.
Yeah.
But once you bundle all of your stuff into that last month, those last few months, then you get a smaller depreciation deduction.
Gotcha.
So
it's just being careful of that and aware of it as well. Yeah. To like, if you have plans for your year to purchase things, spread it out a little bit. Yeah. Yeah. Okay.
Yeah. And there's other things, now bonus depreciation is back into play because of the big, beautiful bill.
I heard you struggle and I was like, it is such a mouthful. Yeah.
It's just like not even, like we're so used to,
like what is that name?
And Jobs Act and, it's very, Secure 2.0 that have these, big, beautiful names. And this one is just big, beautiful. That is exactly. So there are other methods that you can use for depreciation, but that's just one of the things that I normally, especially at the end of the year, unless you really, really need that item, purchasing an item just to purchase it is probably not going to be in your favor because we have other activities that we could do that could really increase your quality of life. And that's really what we're looking for is let's keep this effective tax rate to a reasonable amount, make sure we're aligning with all of your goals while also using the business to be able to increase your quality of life. Because if you're not increasing your quality of life, then why are you working so hard?
Completely fair. Yeah.
So identifying what your tax bracket is, it's always useful to know, but really paying attention to what happens to your effective tax rate and knowing the difference between the two. Because like I said, the tax brackets kind of have like a wide swing. So, I would consider $50,000 like you're broke. You
in 2025?
Yes. Versus if you're making $100,000, you're in the same tax bracket, but we're going to do different things because your effective rates are going to be different. So there's different strategies that we apply there.
I like it.
Yep.
You have made things very clear that have been very murky. So that is very helpful.
If somebody offers you money, you take it. Let's be clear. You want it all. Because, your job is to earn money and my job is to make sure that it's being used effectively.
Yep.
And that you are reaching those goals that you set out to do. So that's what a good tax strategist would be able to help you with. And like it's kind of that CFO advisor role to be able to help you with that. So you need somebody that's more than a tax preparer to really watch and identify the things that you need to do to pull that effective tax rate down.
To be as strategic as possible. Ooh, I messed up that word, strategic. There we go. As possible. Okay.
Right. So I hope you learned a little bit more about how taxes are actually calculated in the United States and the difference between what that marginal and effective tax rate is and how you can utilize some strategies at the end of the year to be able to bring down that effective tax rate so you can accept more money even at the end of the year. So
love it.
If you have any questions, feel free to put a comment below or send us an email, and we look forward to seeing you soon.
Bye, guys.
That's a wrap on Let's Get Fiscal. Ready to stop guessing and start saving? Click the link in the show notes.
Grab your consult, and let's make your business work for you,
not the other way around. You've got this.